There's potentially another flip flop happening at the Federal Reserve, and it has huge implications for you if you're in the stock market. Now, yesterday, I posted a video on a lake, and if you go back to that video and you listen to what I said 6 minutes in, you'll find something very important. I suggest that it's 6 minutes into the video, I suggest the Federal Reserve might let us know that they're going to be more impatient or they're going to be more patient with inflation because they don't want to cause as much economic hardship to employment. In other words, they don't believe that they actually have to crush employment to get inflation down. Well, when I woke up this morning and I read this, I just about freaked out because here's an article in Bloomberg that literally reiterates the maybe I talked about yesterday, and I'm absolutely blown away. Listen to this. Fed backs away from wage focus, bolstering case for rate pause. And I'm like, you've got to be kidding me. The very next day. I'm not trying to pat myself on the back. I'm just trying to say, like, this is obvious. If the Fed stops trying to crush employment, then the Fed will not hike again. This is potentially highly incredible and almost certainly then, if that is true, the end of the cycle. So listen to this. Federal Reserve officials are rethinking their view that wage gains are fueling inflation, a key intellectual shift, flip-flop, that bolsters the case for a pause in their tightening campaign. Now, this is important. They don't give this context, but there's something known as the Phillips curve. And it's basically to say that when inflation is, or sorry, when unemployment, the unemployment rate is low. So in other words, a lot of people are employed. Well, inflation should be high. That's the idea of the Phillips curve. And the Phillips curve teaches you that if inflation is high, you must increase unemployment to lower inflation. That's the point of the Phillips curve, this ability to sort of jigger one up to get the other one down. That's the thesis. If you have too low of inflation, then you want to get to maximum employment. That is the principle behind the Federal Reserve and their rate hike thesis, one of them at least. And so the Phillips curve has been relatively broken for the last about 13 years. Because if you look at about 2013, so maybe last 10 years, 2013 to just past COVID, you've really found, and even till now, you've really found that unemployment could be very, very low without causing substantial inflation. And this has led to a lot of economists wondering, okay, so is the Phillips curve dead? Is it broken? Was it never actually accurate in the first place? And more recently, you're finding, well, it's probably going to be true again. We just needed an inflationary impetus to prove that it was true. But now economists, especially at the Federal Reserve, are scratching their head again, going, but what if the Phillips curve was never correct in the first place? What if we can actually have low unemployment and then high inflation for a period and then come back to low inflation? Now, this is pretty incredible because listen to how this continues. Until recently, many policymakers at the U.S. Central Bank maintained that the road to lower inflation ran through the job market. The idea was that because labor costs make up a substantial portion of the cost of providing services, an area where price pressures have especially been persistent, workers would need to feel some pain. And so this is another very common argument, especially when we talk about core inflation and services inflation. So your more super core inflation. With your more super core inflation, what you're actually saying is, hey, look, super core is really focused on services and stripping out a lot of the goods, the volatile parts like some of the auto sales, the housing sector, stripping out the energy inflation figures. We take all that out, and what we're left with are the things that we really spend money on that require labor, which are going to be things like haircuts, dentists, CPAs, medical care services, doctor services, attorney services, funeral services, right? These are all relatively labor intensive. And so what you find is if you have super low unemployment, there's this thesis that, okay, well, that's going to drive inflation up, right? Because people feel like they can just switch jobs and get higher pay. And that has been true for a very long period of time, especially since there have been so many available jobs. And the argument has been that's clearly what's driving inflation. But now economists are somewhat flip-flopping and they're suggesting, no, maybe that's actually not the case. In fact, the article goes on to say new research and commentary from officials and economists especially at the Fed, suggest the link between wages and prices may not be so direct, and it's arriving just as the Fed is nearing the end of its historic hiking cycle. If the link between wages and inflation isn't as strong as policymakers believe, then you do run the risk of softening the labor market without seeing much progress on inflation. Now, yesterday I suggested that we might end up having a Federal Reserve that says, look, we don't necessarily need to end up causing unemployment. And that is what I think is so incredible is this idea that if the Fed comes out in 2 days and says, we're okay keeping people employed and not throwing people out of their jobs, and at the same time we can be patient with getting inflation down, then we have a massive game changer ahead because markets are not pricing in the Fed being unwilling to let employment or unemployment rise. In other words, markets are pricing in that the Fed is going to cause unemployment. That's what markets are pricing in. And that is the basis of the bear thesis. Because the bears believe once we start causing unemployment, we're going to have an earnings recession. But wait a minute. If the Fed changes the script and says, wait, no, we don't actually need to cause unemployment. First of all, the bears are going to lose their SH9T because we're going to realize, oh my gosh, the whole narrative that we've been told, which is the Fed's going to cause unemployment, will end up being false. That's remarkable. And it's especially remarkable because of the following. So I was debating this bear, and then we'll keep going with this piece here. I was debating this bear just the other day, and it was, well, guess I shouldn't. Oops, that's the other thing. I guess I shouldn't necessarily call it a debate. I would call it more of me asking some pointed questions. We'll put it that way. And the reason I ask these pointed questions is because this person has a bearish tilt. I think they're very educated. I think they're very smart and they have very good arguments. But I do think they very clearly have a bearish tilt, and that's okay. So they make this argument here. Lots of comments about bears being dead lately. I think what people are forgetting is something broke in the system. The regional banking system, Fed forced to inject liquidity via the Bank Term Funding Facility, and markets bottomed since then and have been higher since the end of last year. Now, what's interesting is markets are higher because of the wealth effect, or driving the wealth effect higher rather, which you'd think would reignite another round of inflation. There have been slight cracks in the job markets, and a sign that the economy is slowing, but people's assets are up, so people have more money to spend, and overall the job market has been relatively resilient. So basically, buried into this argument is this idea that, hey, look, you need to cause unemployment because the jobs market has been resilient and people's wealth is going too high, and that's going to cause inflation. Now, my personal counter to that, which is sort of more of a tangent to where I want to get to, my argument to that is obviously check out the coupon code linked down below because we have a big expiration coming up this Friday, which is after this crazy week. But this Friday we'll be having another coupon expiration, mostly because we're going through the starting phases of a new refresh of adding a ton of lectures. We're going to keep the old lectures, but we're adding a ton of new lectures to make sure people get a great start in all of the courses. So we've got some really cool updates coming for those. But really built into this argument here is the thought that if we don't cause wage loss or sort of job loss, then people's wealth will be too high and will cause inflation. The counter to this is, well, look at 2012 really to 2020. We didn't cause inflation solely because people's wealth went up, right? So there's not a direct link between, I would say, the stock market necessarily always driving people's spending up and causing inflation. The wealth effect has a larger effect on consumer spending when it comes to real estate prices. But even then, if our economy can absorb that additional spending, that is because supply is becoming more efficient or we're becoming more productive as workers, then we don't necessarily cause that inflation. So now what I think is interesting is actually, I'm not trying to pat myself on the back here, but I end up replying with, hey, so to clarify, you're basically saying the wage effect is going to lead to higher spending, and therefore a higher propensity of businesses to raise prices, right? And so the response here is, without demand being crushed, inflation will remain sticky and elevated. The wealth effect is driving assets higher, and that keeps the stickiness going. And so the stickiness argument is probably, at this moment, one of the most powerful arguments the bears have, which is that as long as inflation remains sticky, the Fed's going to have to act harder and raise rates more. Now, I dispute that because I believe the Federal Reserve does not actually have to raise rates more. I believe the Fed could actually say, look, we're happy with rates where they are. And what we'll do is we'll just wait for that stickiness to go away. Unfortunately for really the bears, if the Fed just waits for that stickiness to go away, well, then what you end up with is a situation where patience prevails, and if patience prevails, that sticky inflation will probably trend away without crushing markets or employment. But my favorite response here was actually, where's my chart? I had a little chart that I replied with. Oh, maybe it wasn't actually in this reply. Oh, here it is. Okay. So I wrote, and services inflation is still sticky. That was sort of I was summarizing his argument, pre-summarizing his argument. And so then I asked him, I go, how much Fed patience do you think markets are pricing in right now? Because take a look at this chart. This chart here shows that US wage growth continues to soften. But what I really want you to pay attention to when we look at this chart, when we blow this chart up that I posted on Twitter, follow me on Twitter, by the way, at RealMeKevin. When you look at this chart closely, what you'll actually find is that it peaked right at the beginning of where that 2022 number starts, so January of 2022. Well, inflation didn't peak until 6 months later, which suggests that if there is a link between wage growth and inflation, what we'll actually end up seeing is a 6 month delay. And if you look at this chart, you can see we've had the largest declines most recently in wages, which somewhat suggests that if the largest declines in inflation have been recent or in wages have been recent, then the largest declines in inflation are yet to come. So this really coincides potentially with this flip from the Federal Reserve on, hey, you know what? We're going to be more patient. We're not going to force a job loss, because why would we cause job loss if we don't have to? If we could just let the dynamics of basically inflation prove itself to end up being transitory by being patient. Now, don't get me wrong. When I say that, there are a lot of people who say, oh, but Kevin, they were wrong the last time. They were. That is correct. But that doesn't mean they have to be wrong twice in a row. Now, there's a chance of that, of course. We're jaded against the Fed at this point. Remember last time they were still printing money in March of 2022 when inflation was 6%. That was stupid. My 7-year-old knows you don't still print money when inflation is 6%. But that's what happened. Anyway, so looking forward, when you overlay, and this is an interesting chart as well, when you overlay what's actually happening with inflation and you overlay that with what's happening with wage growth, you could see this a little bit more clearly. So I'm going to throw this on screen here, and that would be, well, hopefully it actually ends up appearing. So I'm having a little bit of an issue getting it up at the moment. Hold on a sec. It's supposed to be there, but it's not. Okay, I will plug that in again. But basically, it just overlays inflation coming down with wage growth coming down. And the argument is that, okay, well, if both are slowly trending down, then maybe we don't need to raise rates more. This article continues and also suggests that the prospect of, oh, here it is. I finally got it to show up. Oh, how interesting. Its presentation mode is a little funky, but you know what? That could end up being okay. So we'll just go with it. I think we'll just go with it. Yeah, it's just showing the whole presentation mode, which is usually it's cleaner and just shows the picture, but whatever. So anyway, so here you have that U.S. wage growth, inflation slowly moderating, and we want this moderation to continue. Here on the white line, you'll see U.S. average hourly earnings right here. And we can see we've notched the lowest level here at the lowest advance of wage gains in the last 12 months. So we can see we're really seeing this moderation happening. Slowest advance in nearly 2 years, actually. Look at that. Nearly 2 years, you have the slowest advance in wages here. And then the blue line is inflation. And what you've seen is this decoupling, right? So you see this inflation right here, this blue line, and you see this wage growth actually falling and decoupling away from inflation. That's actually quite remarkable because, again, it's reiterating this idea of, wait a minute, maybe wages aren't what's actually driving inflation. Maybe this really is a supply or was a supply chain issue. Anywho, so that's a pretty big chart. But then there's this idea that, okay, well, what about, the banking crisis, or how is this going to affect jobs in general? And this article goes on to say that initially, while we thought really cooling the labor market was important, this article points out that in just the last cycle In the May meeting, Jerome Powell, in his press conference, said the following quote, "I do not think that wages are the principal driver of inflation. I think wages and prices tend to move together, and it's very hard to say what's causing what." Powell's remarks alluded to a crucial question in the emerging wages versus prices debate. Are wages a large driver of inflation? Or is it more likely to be the other way around? Is inflation a driver of wages? And this is fascinating because it goes back to the argument of the wage price spiral. The thesis used to be that if wages go up, people will be able to spend more money. And because they can spend more money, businesses can end up demanding more money. And then wages go up again because businesses demand more money, hence there's more inflation. You end up getting employees going, well, dude, I can't survive. I need more pay. Maybe that argument is actually entirely flawed. Maybe what's more likely to be true is, hey, a lot of people have more money and they're buying our crap a lot more, and business is doing really well, and we actually have supply chain shortages leading to price increases, but that's leading to profits rising at businesses. Hey, how about letting the employees share in some of those wage gains? Employees get wage gains. Then the supply chain shortages go away and profits stop growing as wildly. And what happens? Oh, wow, maybe wage growth plummets. So maybe wages don't actually drive the prices businesses are setting. Maybe it's really just demand. Okay, interesting. So, anyway, new research from within the Fed system also supports this thesis. A statistical analysis suggests faster wage growth has contributed, quote, only minimally to faster inflation in recent years, according to a column by the San Francisco Fed. The columnist noted that businesses can absorb those costs via lower profit margin or using automation. This is when wages go up. Businesses can basically absorb those with more productivity or whatever, rather than solely continuing to raise wages. Before the pandemic, often groups often referred to pay bumps as basically the start of inflation, but we've really not seen that inflation. Let's see here. We also this was a good chart as well. Then they go into this chart on small businesses and wage gains. There we go. I fixed the iPad in the meantime. Take a look at this. Fewer small businesses plan to boost pay. Share of companies actually raising wages remains elevated. So, in other words, you have the blue line indicating net percentage of small businesses raising wages, or sorry, that's the white line, and then the blue line is net percentage of businesses planning to raise wages in the next 3 months. So you have this differential of basically, hey, have you raised wages versus are you going to raise wages? Now, I'd really like to see Bloomberg or somebody do is I would like to see this chart for companies like Pepsi and Kimberly Clark and Procter and Gamble, and basically your consumer staples, where they keep bragging about having raised prices. But I actually think the chart here is very much the same, where you have a lot of businesses who have just raised prices or year over year have raised prices, but the number of businesses planning to raise wages going forward or companies planning to raise prices going forward is much lower than those who have. So I actually think this is quite a fascinating chart because it really shows you that difference. Additionally, they have some quotes in here about how there's this mismatch between mapping inflation and wages, and I think that really just goes to reiterate some of the things that we've just talked about. But I want to talk about some of the implications of what this Federal Reserve policy shift could mean, and specifically how we might identify it in the FOMC conference. So, first of all, if the Federal Reserve suggests that, yes, indeed, we are willing to let the unemployment rate stay low because we don't believe that the unemployment rate causes inflation, then what the Fed is really doing is they are telling you, hey, everyone, we're not going to force a recession. In fact, we think that inflation can slowly go away without causing joblessness, and your stocks are going to go up. That, I think, is in the most clear English what this Fed flip-flop could mean. Now, I understand there are these traditional arguments. For example, somebody who takes this argument very clearly is actually somebody I met on a playground, which sounds very odd. But Chamath has this sort of traditionalist argument of we need to see the Federal Reserve absorb liquidity. We need to see the Federal Reserve continue with their quantitative tightening. And basically, all of that money that was injected into the system needs to be sucked out. And that sucking out is going to drive markets lower. Chamath has been a big proponent of sort of not being in the market, not being exposed to a quantitative tightening regime because we don't know the outcome of quantitative tightening. And this is a very fair argument because technically he should be correct, but he might not be correct because when we look at the first sort of real drawdown of refilling the Treasury General account, for example, last week, we look at this first real liquidity drawdown. What ended up happening? Well, what ended up happening was, and again, I'm not trying to pat myself on the back. It was just a very clear prediction. What ended up happening was what we talked about. The reverse repo facility saw its balance go down, and we saw the Treasury General account go up. In other words, some of this quantitative tightening that everybody is afraid of is really being buffered by the repo facility. Now, so what is the repo facility? And explain it to me like I'm five. Basically, when banks have extra money bags sitting around, they can put those money bags at a special place. And we call that the repo facility. And the amount of money bags sitting there is roughly in the amount of $2 trillion, which is pretty remarkable because it's a lot of money. And we just saw reverse repos drop about, let's see here. I'm trying to pull up a chart of reverse repos if I can. But we just saw the reverse repo facility drop about $106 billion as the TGA, the Treasury General account, was being filled up. And it's not a surprise because you can actually make more money buying 6-month T-bills right now than you can make in the reverse repo facility. And so what's great about this is really another way of saying that the Federal Reserve can allow this tightening to occur. And all we're really doing is removing some of the buffer that banks have. We're not necessarily taking that away from people. This is phenomenal. So really, you're in this, I hate to say it, but potentially giddy, scary, Goldilocks environment where we don't cause massive unemployment. We therefore don't cause a recession, or if it is a recession, it's very nominal. Quantitative tightening doesn't actually hurt us because the reverse repo facility buffers us. Once the reverse repo facility draws down to zero, which will take a very long period of time, and we consider even if you're tightening to the tune of 100, which you're tightening to the tune of about $80 billion a month. But let's consider, along with Treasury borrowings, it's $100 billion a month. It would take you 20 months to draw down the whole repo facility. 20 months of drawdown is basically just over a year and a half. A year and a half from now, we'll be in 2025. The economy could be so beyond a recession that any of the actual impacts of tightening might not matter at all at that point. At that point, it's like, sure, go ahead and tighten. Don't worry, the party's still going. So again, I'm not trying to come across as like this perma bull. I really am trying to study the bears as much as possible, and I'm trying to understand what everything is happening in the economy. And it's very difficult to put it all together, but when you start putting the pieces of the puzzle together, you go, wow, if the Fed on Wednesday reiterates their shift away from causing unemployment, first of all, that'll be very politically popular, and you're going to get a lot of people alleging that Janet Yellen and Joe Biden gave the Mr. J. Powell a little phone call, and they're going to put their tinfoil hats on, and they're going to make the argument that this is all politically motivated to ensure that Donald Trump can't be elected. That's the argument that's going to be made. Trump, by the way, goes to court tomorrow in Miami at 3 p.m. But anyway, aside from all that, it's interesting because it seems like the folks peddling the bear narrative are grasping at straws. And I'm not suggesting there won't be a black swan, but let me just put it this way. I don't think right now, other than the inverted yield curve, there's so much terribly scary. And this flip from the Fed really reiterates that potential. And it's kind of mind-blowing to me. Kind of mind-blowing. So I want to be, as I say, the cautious optimist. But the more studying we do, and I think together, the more we discuss this, the more we start realizing the Fed is not trying to destroy this economy, and that is going to be statistically very, very good for the stock market, which is also quite strange because it doesn't feel like we should be hitting, all-time highs over the last year. I guess that's 1-year highs, those aren't all-time highs. But soon enough, we will probably surpass November of 2021, and I think people are going to lose their mind if the stock market surpasses November of 2021 and goes back to sort of this euphoric era, without some kind of recession first. But you know what? I'm here for it. So, yeah, with that said, have I reminded you about our paid promotions like StreamYard? StreamYard is what I'm bringing this content to you by. I could throw up little banners like paid promotion. I could throw up little screens around the edge if I wanted to. Take a look at this. Take advantage of a special price on the courses I'm building with. Link down below. You can also use buy now, pay later now, which is kind of cool. I'd say maybe about 30% of people are using Klarna, Afterpay, Affirm to check out on the courses. Although you can get in pretty, I would say overall inexpensively for the value you get. And you get lifetime access. You get our course member live stream, which we'll be going to after this stream. And I look forward to seeing you there. So, yeah, check that out. Link down below. We've also got some other links down below. Another link down below that I really wanted to point out is actually a new one. See this device? Well, actually, the camera that I'm filming on, and I'm still playing with some of the settings on this, so I still have some learning to do. But what's really incredible is I have this little thing called an Insta. What is this thing called? I don't know. Just go to metkevin.com/webcam, and so I have this new camera that will actually follow my head where I go. You can see that? And so I have my hands free right here, and this camera will actually follow me where I'm going. Oh, I disabled it by doing visual commands. So you can actually also disable this with visual commands. Like I can put my finger up like this, and then it flashes blue to acknowledge me. And then hold on, let me make sure I'm doing it right. Something to this effect, and then I should be able to. Is it going to work? Somehow. That's probably. Oh, there it zoomed in a little bit. It's on face tracking, so I saw it zoom out again right away. But the point is, you could do like these hand signals, and it'll zoom in and out. I really think the face tracking thing is pretty cool though, because it just keeps you centered in here, and it zooms in on you as you move around. I don't want to cause anyone queasiness, but it's really cool device. So check that out. metkevin.com/webcam. It's probably, I would argue, the best webcam that I've used, and I've been traveling quite a bit. I think I've tried about 5 different webcams. There was actually a point where I just resigned myself to using the Mac webcam, but then I was in New York and I had this massive glare and I couldn't get rid of it because it's just a computer webcam. And I'm like, I need to get a better camera. So I finally did. And here it is, metkevin.com/webcam. All right. So that concludes that Fed piece.